The purpose of this short video is to differentiate between the three types of audits. First, what we have here is an operational audit. And its main purpose is to evaluate the efficiency and effectiveness of an organization. And to further this, operational audits focus on the review and assessment of business processes. The activities of the business processes may result in a direct or indirect financial impact to the organization, such as, for instance, the collection of student tuitions or patient account balances. Internal audits primarily focus on operational audits, but can extend the scope to include accounting procedures that can impact financial reporting. We also have compliance audits, right? So it determines whether the auditee is following specific procedures and other rules and regulations and things of that nature. Its main purpose is to review the level of compliance within internal policies or external regulatory requirements. These external regulatory requirements, of course, is connected to the independency that is needed in accounting as presented in a prior video. We also have financial statement audits. Financial audits typically involve a focus on financial controls as they relate to reporting. These audits focus on accounting controls present in the general ledger or subledger systems. Financial statement auditing is the focus of our external auditors. Why? To present better information that other users can rely on. Internal audits will complement the work they perform based on an agreed plan that is usually connected to policies and procedures internally or externally. And again, as it indicates in that last statement, the criteria are normally US GAAP or international accounting standards. Now, here are some examples of the three types of audits. Now, let's look at the operational audit, for example. It says here, the example is evaluate whether the computerized payroll processing for a Chinese subsidiary is operating efficiently and effectively. Right? So we have to go through certain procedures in order to test it out, because that's essentially what we're doing. When we're auditing something, we're basically testing out to see if it's true, to see if the hypothesis is true. So the information that they provided in this example is the number of payroll records processed in a month, cost of the department, and the number of errors made. So in looking at the numbers of errors made, we'll be able to assess if it's operating effectively. If it's operating efficiently, the number of payroll records should match the number presented in another subsidiary journal. So for instance, if we get paid bi-weekly and we have 5 employees, at the end of the month, there should be 5 different payroll checks. And if there aren't 5 different payroll checks, then we need to test out if it's really operating efficiently. And the established criteria that it indicates here is company standards for efficiency and effectiveness in payroll department. So basically they created their own rules and regulations, and they're trying to see if these rules and regulations should be changed based on whatever result that they have, whatever conclusion that they have. And through the available evidence, they have error reports, probably within QuickBooks or their payroll system, their payroll records, which can be printed out within different systems, and their payroll processing costs. The reason why it says payroll processing costs is because if for instance, we have a low amount of payroll costs, but a high amount of employees, maybe we're not processing it correctly. Because the allocation based on how many employees there are, it should increase the processing costs. So the more employees that you have, the more processing costs that you should have. We also have another type of audit, as referenced before, which is the compliance audit, which is the example that they give here is to determine whether bank requirements for loan continuation have been met. And what type of information are they going to review? They're going to review company records. And the established criteria that they have is usually loan agreement provisions, but these established criteria can also come from other organizations like HUD, right? So anything dealing with homeowners insurance or anything dealing with just the bank policies or procedures that we have in the United States can be some of the established criteria, not just the loan agreement provisions. And the available evidence that we have to see if there is compliance that is met, we can look at financial statements and the calculations by the auditor. And how we know that the auditor is making the right calculations, we're just going to have several tests. So we're going to look at several samples. Maybe if there's a group of, say, 10 examples that they have within the loan agreement, maybe we may look at all the odd numbers, right? We may look at number 1, number 3, number 5, number 7. Right? So we may look at the odd numbers, we may look at the whole thing, so it really depends how big that loan agreement is. We also have a financial statement audit. An example that we're going to review is the annual audit of Boeing's financial statements. And Boeing is an airline company. Well, not really essentially an airline company, but they create airplanes. And the type of information that we would normally review in order to audit the financial statement is essentially just looking at the financial statements. And the criteria is mandated by the governmental systems that we have in place, which is generally accepted accounting principles. That's what it has to follow because the external users need to rely on this information. And the available evidence are provided for by internal auditors as well as external auditors, which is the documents, records, and for example, if we were auditing your financial statement, your personal financial statement, we would look at your bank statement and we would look at other records that you have for all of the income that you're generating, not only in the United States but for other places. So the available evidence that an organization has is the documents, the records, and other outside sources for evidence. And those are the examples of the 3 types of audits that we need to understand through auditing.